I will say, one, Kenny Anderson, it, the, they're big, we've been big MLP
Yep.
investors forever. So for sure. And that's where the value orientation, that's one way to have, that value manifested
Mm-hmm.
itself for sure. In real estate, um, it was clear if you can get something done, you were going to win.
Yep.
You just had to get it closed, right? And so, I was doing a bunch of smaller things, some non-performing loan portfolios, senior housing here. I bought, 5 or 6 apartment buildings, smaller value add type deals. And then the bigger deal that during that period of time was in early '09. I started working on this 600 unit apartment complex. I lived in Chicago, and I very early concluded that the seller was nuts and there was no way he was out of the money. I had to go to the lender.
Mm-hmm.
So after months of dealing with how to get to the loan, how to get to the lender, I finally was able to get to the lender and figure out how to get it under agreement. It was a class F deal, maybe D minus, okay, but in a B plus A location, great location. But the previous owner just let it go. It was terrible. So, but we were buying it for 20,000 a unit.
Wow.
So anyhow, long story short, 3 days before closing, I had my money, my uncle's money, and when I say my money, I had it was everything but $10,000. Okay.
Mm-hmm.
My wife had no idea what I was doing. And this deal was too good. My uncle, he and I were hard money, $1 million. And 3 days before closing, my partner, so I had a money partner, they walked. And so my main LP said to me, okay, I'll lend you money for 90 days. You take no fees. I know you could do this. Make me proud. 88th day, replace my GP partner. The deal ends up being a 4X. But there was a 90-day period where I thought I might have lost all of my money and my uncle's money because I had to find a replacement for the guys who left me at the altar 3 days before closing. So that was that time period. If you could get it capitalized, you were going to win. But it took everything and then some to get these things closed. So anyhow, so that time period. And then I joined Kane in 2012. We had 750 million under management. We were primarily student housing. Al and I see the world the same way, downside protection oriented. And then we wanted to build this all weather business that was relevant and active and outperforming in all cycles. The way that we're going to do that was through not only equity, but at a debt business over time, diversify not into a generalist, but as an alternative investor in low correlated sectors like student housing, right? Good times are bad, people go to school. Senior housing, good times are bad, people need homes, senior homes to live in. Medical office, same sort of thing. Self storage, light industrial, these sorts of things have a lot of resilience that are not correlated to the broader economy. And if you look at demand, which this is a very important point, in real estate, being a demand centric investor is critical because supply is inelastic. You have surges of supply from time to time, but if you have robust structural demand, that supply will get absorbed over time. It may not be, as you anticipated, but the binary element is not there because demand will always help you through any kind of supply. If you have a one horse town or a two-horse town or anything that is very episodic or has, like, for example, when there was this big fracking boom in the Dakotas and parts of Texas, there needed these apartment buildings for all the workers. But if you thought about it, what if the efficiency started to increase, or what if the oil reserves became much less, right? You would not need those apartments. And so what happened is that was very binary. The need for those apartments dropped off off a cliff, and because of the efficiency and technology, they needed a fifth or something like that of the workforce. So we stay far away from those sorts of things, and we focus on apartments across the street from University of Michigan, Wisconsin, Florida, those sorts of things, right? Healthcare systems that you go to the doctor, you need a knee replacement, you need, any kind of cardiovascular services, oncology, those sorts of things. That's what we do. And we do it through our opportunity funds. We do it so that's your, two times your money, 20% returns. And then we have an open-ended core fund, which is low leverage, long-term, 10% returns. And then we have a debt fund series where we're making loans and buying loans, all in the same downside protected, low correlated sectors. And so, that started in 2012. Fast forward to today, we went from 750 million under management to, we're 18 million under management today in these things that we do. And I will say when, times like, when COVID hits, right? When COVID hit, we weren't on the sidelines. We were leaning in, and we bought or lent money on 5 billion or so of real estate. So anyhow, that is how we built this business to not only be all weather, but be able to really lean in times of dislocation. And so these sorts of markets today, when you have so much noise about tariffs, geopolitical risks, all those sorts of things that creates some inefficiency or illiquidity, that's when we're at our best.